The silver price in Shanghai, again, is trading at about a 6% premium arbitrage. This is what we're seeing, more stuff flow that way for arbitrage. And that stuff's never coming back. You know, we look at all of the metal that left COMEX recently, and we talked about that last week, how so much is leaving. If you have to get it reassayed to come back in, and I told the story of, I have a client with a bunch of 1,000-ounce bars in JFK Brinks. We have 9 Brinks locations. That one is the only COMEX facility, and she wanted to move it to Salt Lake City, and I advised her against it because I was told by some people in the COMEX that if it moves from Brinks JFK to Brinks Salt Lake City, it doesn't matter if it moves by Brinks truck, never leaves the Brinks ecosystem, it left the COMEX ecosystem. And once it does, it needs to be reassayed at a significant time delay and cost. So when this stuff leaves COMEX, it ain't ever coming back. The little man rule is, you know, I learned about it in college in macroeconomics, and then basically, you know, day one of our econ class, and you know, the little man never wins. The little man is the herd. The little man is following the herd because they don't have the courage or the time or the understanding to think for themselves in terms of investing. The trend is made long before the little man catches it. And you can see that, like, for example, right now. I mean, there is no better contrarian indicator than I've ever seen in my career than seeing massive insider selling. The institutional is selling between 2 and 4 billion a week since June 1st. I've said this for the last 2 weeks over and over. Bezos selling 6 billion in Amazon since June 1st. Buffett, Jamie Dimon, all of these people sitting on huge amounts of cash and selling securities when the public is all-time record high investment in the equity markets.
Recent months highlight this divide. Billionaires like Jeff Bezos sold nearly $6 billion worth of Amazon stock since June. Warren Buffett, Jamie Dimon, and other financial titans are hoarding cash while trimming stock holdings. Meanwhile, retail investors are charging into equities with record-high margin debt and unprecedented option speculation. Insiders quietly unload billions weekly, signaling caution while the little man doubles down. This pattern is a textbook contrarian signal. When the crowd buys in euphoria, the professionals often exit. The result? A dangerous setup where small investors may once again bear the brunt of a coming correction.
All-time record high margin debt, all-time record high option exposure. This is a speculation to the nth degree as the insiders are moving the other way. And then you see the massive deliveries coming into COMEX, we're going to talk about in a moment, nonstop. And the public having no idea. I mean, when you talk about the little man, that is the little man. The little man is going the wrong way, always loses, always makes the wrong move because he follows the herd. And the big money uses the rhetoric, the information or disinformation or misinformation to position themselves before everyone else. It's like, who is the big buyer of metals in the United States? Whoever the hell it is, they want physical delivery. They don't care about prices. As gold has gone higher, they keep buying. And, you know, could it be? To me, it's the government. And whoever it is, they want the gold. I think it's the Fed or the Treasury. But, you know, it's certainly not just tariffs and arbitrage. It has nothing to do with that, as far as I'm concerned. So yeah, this is a big deal. It's a very big deal. And I think the little man wouldn't even notice all of this gold talk because they're all-time record high into the equity market. Speaking of gold and silver, let's talk about it for a little bit. The central banks did buy 166 tons of gold in the second quarter. That's a 41% increase over historical averages. It's one of the most significant quarterly totals in history. Food for thought, again, the insiders. Public has no exposure to gold, yet this is one of the most historical, significant quarterly totals in history. I don't know, just saying.
While the public chases stocks, powerful institutions are quietly accumulating physical gold. COMEX deliveries have surged, with millions of ounces being withdrawn. Whoever is behind these purchases isn't worried about short-term price swings. They want physical control. Analysts suspect U.S. government entities like the Federal Reserve or Treasury could be involved, though no one knows for sure. Central banks globally are also stocking up, purchasing 166 tons in Q2 2025, a staggering 41% above historical averages. Yet retail investors remain almost entirely absent from gold. The divide is stark. Insiders seek real assets while the herd ignores them.
The silver price in Shanghai, again, is trading at about a 6% premium arbitrage. This is what we're seeing, more stuff flow that way for arbitrage. And that stuff's never coming back. You know, we look at all of the metal that left COMEX recently, and we talked about that last week, how so much is leaving. If you have to get it reassayed to come back in, and I told the story of, I have a client with a bunch of 1,000-ounce bars in JFK Brinks. We have 9 Brinks locations. That one is the only COMEX facility, and she wanted to move it to Salt Lake City, and I advised her against it because I was told by some people in the COMEX that if it moves from Brinks JFK to Brinks Salt Lake City, it doesn't matter if it moves by Brinks truck, never leaves the Brinks ecosystem, it left the COMEX ecosystem. And once it does, it needs to be reassayed at a significant time delay and cost. So when this stuff leaves COMEX, it ain't ever coming back.
Silver is following the same path. Deliveries on COMEX have been extraordinary, with millions of ounces leaving vaults never to return, as once withdrawn, bars must be reassayed to re-enter. August alone saw nearly 9 million ounces delivered, worth almost $300 million. At the same time, Shanghai silver trades at a premium, drawing Western supply eastward. These flows suggest that sovereigns and deep-pocketed buyers are securing silver while it's still accessible. Meanwhile, retail investors remain focused on equities and tech stocks, missing one of the largest stealth transfers of precious metals in modern history. The little man stays blind.
So we talked about the amount of gold deliveries. The first 3 days, it was just over 20,000 contracts, over 2 million. Month to date so far, just shy of 30,000 contracts have been delivered. And so again, you're talking 3 million ounces of gold, right? So who has this kind of money for 3 million ounces of gold? I don't know. I mean, there's still a whole bunch of contracts left open that can settle. And we've seen an increase, a big increase in the amount that initially say they're going to post for delivery, and then the addition of almost 9,000 contracts since then that have stood for delivery. Silver so far, it's just under 1,800. So at almost 30,000, that's 100 a contract. That's 3 million ounces. So let's just play around and do the math. It's going to be just under 10 billion, but, well, we can figure it's just under 10 billion.
The stock market's concentration reveals growing fragility. NVIDIA now represents 8.2% of the S&P 500, 3 times the size of the entire U.S. energy sector. This imbalance shows how speculative mania can inflate a single company beyond reasonable proportion. Meanwhile, the energy sector, vital for powering AI-driven data centers, is undervalued. Add to this the U.S. Treasury auctioning an unprecedented $724 billion in 1 week, including record short-term bills, and risks become clear. Financing long-term obligations with short-term debt mirrors a household paying mortgages with payday loans, unsustainable and dangerous. Yet retail investors remain oblivious to these warning signals.
Or just over 10 billion at 3,400. But when you look at the silver, let's check that out real quick. 1,720 contracts times 5,000 is 8,600,000 ounces have stood for delivery, just a tiny little bit. So you can see the big money is continuing to drain the exchange. And the deliveries have been huge all year in silver and in gold. So in August, there was 8,600,000 ounces delivered so far. So, you know, who's standing for delivery done again for 8 million ounces of silver so far in August? What's that? What is that? 8 million times, call it 37. That's $296 million worth of silver that has stood for delivery so far in the month of August, which is big. I mean,
the recurring theme is unmistakable. The little man follows the noise, while insiders act on foresight. Gold and silver deliveries, central bank buying, record insider selling, and structural imbalances in equities all point to a coming shift. If history repeats, the herd will once again be caught on the wrong side. The lesson is simple but often ignored. Think independently, diversify beyond paper markets, and watch what the insiders do, not what they say. In the end, survival in uncertain times isn't about chasing trends, it's about anticipating them before the crowd arrives too late.
I don't know. Who is this big buyer? That's the question. Let's see. Did I find anything else worth talking about? Looking at the stock market, I noticed that NVIDIA alone is now 8.2% of the S&P 500. That's 3 times the size of the entire energy sector. And that energy sector is made up of 25 stocks. And most of those energy sector stocks are directly involved with producing the energy required for data centers, full of machines which are full of NVIDIA chips. Just saying. Treasury demand. The government auctioned off $724 billion worth of Treasury securities last week, in a week. Short-term bills comprise the majority, $505 billion, including $100 billion in 4-week Treasury bills. That $100 billion auction of Treasury bills is an unprecedented, highest ever amount of short-term treasuries that they've ever sold in one time. And I don't know, it's dangerous to sell short-term debt to fund long-term debt, just saying.